Did you know there are finance options available if you're keen in projects involved in property development? Hi guys, welcome to our channel. Today I'm going to talk about one of the finance option, and that is bridge loan. A bridge loan is a type of short-term loan typically taken out for a period of 2 weeks to 3 years, depending on the arrangements for a larger or a long-term finance. A bridge loan is also known as gap financing, swing loan, interim financing, or caveat loan. If you're keen in knowing more about property development, don't forget to subscribe and hit that bell icon so you will be notified on our next video. Is bridging loan really a good financing option? Stay tuned till the end of the video to find out. Bridging finance could be used for a lot of reasons. Few of the reasons are buying a property or say moving house. Bridge loans are often used by homeowners between selling their home and buying a new one. Perhaps you have found your perfect home, but you haven't yet found a buyer for your existing property. A bridge loan would be the only option to avoid losing your dream home. Bridging can be used to secure a deposit on your new home and can be repaid once your existing house is sold. Another reason why you would take a bridge loan would be for property development. Bridging loans can also be used by property developers, and they often are. For instance, a developer may have secured planning permission to build multiple dwellings. With the cost of buying land on which to build and the forthcoming cost of laborers and builders, the developer may look at bridging finance to leverage the cost of the development. Once the development is complete, the developer could either remortgage, move to a commercial mortgage, or sell or rent the development and repay that bridging lender. Property investors may want to buy, renovate, and sell a property, like what happens in flipping strategy. As mortgages are generally long-term, bridging finance could be more of a viable option. Another reason for using bridging finance would be for buy-to-let investment. Landlords may want to buy, renovate, and then let the property to tenants. Now, in this case, a bridge could be used to purchase an unmortgageable property and even fund the renovation. Landlords can then remortgage the property once it's mortgageable and repay the bridging lender while profiting off any surplus funds. Bridging finance can also be used for business ventures. Now, bridging loans are also used by property developers at auction. Landlord and investors often use bridging finance when they need to fund a new deal or bridge the gaps in their existing deals. Investors sometimes use bridging loans to secure the auction properties. This is because they often need to pay a deposit to secure their purchase at a short notice. Now let's look into certain advantages and disadvantages of bridging loan. Now let's look at the advantages of bridging loan. It's a short-term loan. There is an ability to choose repayment options, quick access to loan, and it overcomes the issue relating to cash flow. Let's look at the disadvantages of bridging loan. The interest rate is high. It might increase the debt burden if you're not able to pay the lender on time. Some loans might have prepayment penalties, and this loan should be paid prior to any other traditional loan that you have. Now let's see, how does the bridge loan work? Now, working of the bridging loan depends on the purpose of the loan. Say, for example, you want to buy a house worth £300,000. you want to have £100,000 as a deposit. You have £20,000 saved in cash, so you need £80,000 more for the deposit. Now, you're waiting for your current house to sell worth at £150,000. So you take a bridging loan for £80,000 to bridge that gap for the deposit. And then you repay that bridging loan once you sell your old home. Now let's look at the types of bridging loans. Open bridge loan. In these type of loans, they have no set end date. This means they can be repaid whenever your funds becomes available. But keep in mind, open bridge loans have more risk attached from the viewpoint of a bridging lender. This is because there is no fixed date for when the loan is to be repaid. That being said, bridging lenders will often request the loan to be paid back within 12 months. The next type of bridging loan is closed bridge loan. Now, as the word suggests, closed, so it has a fixed end date. For instance, you have a buyer for your home that have exchanged contracts but not yet completed the purchase. So once the completion takes place, you receive the funds from the property sale, and now you can repay the bridging lender. As the bridging lender has a date for completion and there is a clear exit strategy, this would be classed as a closed bridge loan. Now, there are certain points to consider before you decide on bridging loan, and they are how much you want to borrow, how much is your property's worth, how long do you need to borrow it for, and whether you have a mortgage on your property. Now, this affects how much you can borrow through a bridge loan. It also affects whether you can look at first charge or second charge loan. Now, what are these first charge loan and second charge loan? Let's look into it. First charge loan. First charge loans are where the bridge loans the first or only borrowing secured against your property. Mortgages are normally first charge loans. But if you have no mortgage or no outstanding borrowing on your property, a different kind of loan, like a bridge loan, can be your first charge loan. If you're in the process of selling your home and haven't sold, but you took a bridging loan to secure your new property, the loan would be secured on your new property as a first charge loan. Second charge loan. Second charge loan are where there is already a loan or a mortgage against the property. Second charge lenders usually need the permission of the first charge lender before they can be added. Interest isn't the only cost on bridging finance. There are quite a lot of other fees you might come across. These include arrangement or facility fee, exit fee, administration or repayment fee, legal fee, valuation fee, introducer or broker fee. There might be other fees too, so bear in mind before you decide if bridging finance is right for you. You must be wondering, what's the difference between a mortgage and a bridging loan? Bridging is very short term in comparison to a mortgage. Mortgages are usually taken out on a 25 to 35-year terms. Bridging loans are generally offered for a period of 2 weeks to 3 years or less. Interest rates for bridging loan are higher than the mortgage interest rates. Bridging is popular with auction buyers to secure the rundown properties that won't qualify for mortgages. Mortgages are usually repaid on a monthly basis. Bridging loans can be rolled up and repaid as a lump sum once the term expires. Using bridging finance can be very risky. You are able to calculate the risk depending on the quality of your proposal. That's why bridging lenders may assess your experience, will carry out valuations to ensure the proposal is of quality. A specialist would advise bridging loans as a last resort. If you're unable to remortgage or withdraw funds elsewhere, then a bridging loan may be your only option. The advice is based on the fact that bridging finance has a very high interest rate. In the worst case scenario, if your plan don't go as expected, you could be left with ever increasing debt. But bridging loans can be a powerful tool if you used it correctly. That's all for today. Have you taken any bridge loan before? If you have, share your experience and post it on the comments. Thank you for watching.